The Chinese government took extraordinary measures to stem the Shanghai Composite's drop. For example, it banned large institutions from selling stocks. That was just one measure. By some estimates, China's central bank, the People's Bank of China, contributed at least $13 billion to propping up the market this week. GGV Capital's managing partner Jeff Richards has been investing in tech in China for decades. So, Jeff, you've invested in Alibaba, numerous other companies, private, public. What is your take on this week? What were you thinking when you saw the markets drop like a stone?
Well, it hasn't just been this week, Deirdre. It's been dropping for about a month, and it's been quite a crazy year, really. The market in China, there are several exchanges in China, and they had risen up to June 12th about 150% on average. So it's been a crazy year, and then in the last 30 days, you saw them drop by as much as 30%. So it's been a wild ride, and I think this week is the week where it really caught a lot of investors' attention around the world. You know, our thoughts, having been on the ground in China for 16 years, we're used to some volatility. We saw the run-up coming, and it was largely due to an increase in margin loan activity among consumer traders in China. About 60 to 70% of the trading in China, maybe even more by some estimates, is done by individual traders, not by institutions. And so as margin debt increased for those traders, they increased their positions in Chinese stocks, and you saw a big run-up in the first 6 months of the year. I think a lot of folks who were on the ground and in China expected some sort of a pullback, and obviously it happened in a fairly aggressive way in the last 30 days. So it's been a little bit of a wild ride.
So the pullback was aggressive, but the Chinese government's actions also aggressive. We named one of the measures, which is basically if you're running an investment business, you were not allowed to sell. You also could not bring any new companies to market, so no IPOs. The Chinese government wanted people to be able to support the actions, the stocks that exist already. What does that make you think as an investor, as someone who does business there, when you see the Chinese government come in? How do you read that?
Well, the no IPOs rule is not new. They had done that previously a couple of years ago. And the government does take action when it needs to keep stabilization in the market. And in fact, it worked. I mean, if you look at the end of this week, you saw some of the stocks tick back up and a little bit of stability in the market. Now, to your point, that's because somewhere around 1,700 equities were untradeable. They were essentially taken off the exchange for listing or for trading this week. So the actions did work to some extent, and I think you'll see the government continue to take action to stabilize the market. Over the long run, if you think of sort of a 5 to 10 year horizon, there is a stated objective among the government to create a more vibrant stock market in China with more active participation from institutional investors and consumers in China. So this is part of a long-term effort to foster a more interesting stock market in China. And one of the things you're seeing, potentially drawing a line over here to the U.S., you are seeing some of the Chinese companies that have listed here in the U.S., which trade as what are called ADRs, take private offers or go private offers from CEOs and other investors to take the company private and potentially relist in China. So that's an interesting trend that we're keeping a very close eye on and would have an impact for U.S. investors and other investors around the world, whereas the volatility in the local markets in China generally doesn't impact investors around the world because they don't have positions in those equities. It's mostly domestic mainland investors, and as I mentioned earlier, about 70–80% of that is consumer traders.
All right, Jeff, come back and talk about the ADRs, the American Depository Receipts. Interested in that trend that you're following. Jeff Richards with us there, managing partner at GGV Capital.